From New York City for our viewers worldwide, I'm Katie Greifeld. Bloomberg Real Yield starts right now. Coming up, hot PCE points to sticky inflation, boosting bets on more Fed hikes to come and sending investors running from junk bonds. We begin with the big issue, another hot print.
Bad news.
Bad news.
Bad news across the board.
PCE number?
Still quite hot.
Inflation is heading the wrong way.
We are not going to have inflation back to a 2% range before 2024.
We're in a very abnormal situation right now.
The Fed is going to continue its path.
Is it 5, 5.25, 5 3/8? I think that remains the baseline, but the balance of risk is clearly to the upside.
It's going to be harder for them to stop raising rates.
They're going to keep rates high for a long period of time.
They have a real problem there.
There's too much that we need to get through.
There could be more pain to come.
Joining us now, we have Charles Schwab's Collin Martin and Newedge Wealth's Cameron Dawson. Great to have you both with us. And Cameron, I want to start with you, and let's just recap some of the numbers that we got at 8:30 this morning. Core PCE came in at 4.7% year over year. The estimate was for 4.3% in January. It was a similar size and scope, a beat when you look at the month over month data. And when you put that all together and you think about the reports that we've gotten in the past few weeks, did the Fed downshift the pace of rate hikes too soon?
Probably yes. And we think that all the talk about disinflation was likely misplaced because we did see disinflation in the back half of last year, but it was driven by two very narrow parts of the inflation picture, gasoline prices and used car prices. The rest of the components still remained rather elevated. So as those have turned higher to start this year, that's why inflation is reaccelerating. But when we look at the PCE data, it was so broadly inflationary. You saw the number of components that were above 4% tick up as well. And even that super core measure, the PCE X food, X housing, X gasoline, also ticking higher. And that just shows you that the Fed still has more work to do in this fight against inflation.
Yeah, whenever I hear super core, I just picture a bunch of asterisks next to that number. But Cameron, if the pace of inflation is reaccelerating, do you expect the Fed to reaccelerate the pace of rate hikes in response? Should we put 50 basis points back on the table?
I think that that probability is ticking higher, but I do think that 50 basis points is now going to be highly dependent on the February print for CPI, which we get about a week before that Fed meeting on March 21st. And so if that comes out hot again, we would expect 50 basis points to come through. If it's a little bit softer, maybe they stick with 25, but we think we're pretty locked in for 25 in March, 25 in May, and then another 25 in June.
And so, Collin, in reaction to the PCE report, we heard from Cleveland Fed President Loretta Mester. She told Bloomberg News that the report is, quote, just consistent with the fact that the Fed needs to do a little more on our policy rate to make sure that inflation is moving back down. A little more there. At the same time, we got a study coming out from the likes of JP Morgan, Deutsche Bank were among the authors, and they found that simulations of our baseline model suggest that the Fed will need to tighten policy significantly further to achieve its inflation objective by the end of 2025. So you just look at the words that they're using. Mester saying a little bit more, Wall Street saying significantly more. What do you think reality actually looks like here when it comes to the Fed's tightening path?
It's probably somewhere in the middle, but I'd lean towards what Mester said. When Mester came out this morning, nothing of what she said was really much of a surprise. We know that she already favored a 50 basis point hike at the last meeting. So for her, highlighting that it might take more given that hot print this morning isn't much of a surprise. That study that you referenced, that was pretty shocking because you had a pretty big mix of, academia and some large banks. And to talk about simulations of 5.5%, 6.5%, that's very high and way above what most of us are expecting right now. So never say never, but we think they'll likely take a measured approach. I agree with what Cameron said before. We're expecting 25 basis point hikes now at the next 3 meetings of March, May, and June.
And so to focus on that study a little bit more, there were 55 pages. I haven't read them all yet, I will admit that. But they wrote that the computer models spit out a terminal rate of perhaps 6.5%. 5%. So I remember when we were talking about 5% Fed funds. That seems pretty quaint now, Collin. Should we be talking about 6.5% when you think about the end destination for this Federal Reserve?
That seems a little bit high, but what we're looking at and talking about a lot here at Schwab is what that neutral rate is or what that natural rate is. Because the amount of tightening we've seen so far, yet still seeing elevated inflation readings, still seeing that healthy consumer spending number, shows that it hasn't had much of an impact. So maybe that neutral or natural rate is a little bit higher than expected. When you look at FOMC projections, when you look at that long-run goal of 2.5%, I think there's this thought that maybe that's what the neutral rate is right now. I think there's a lot of concern still because the Fed discontinued it because of the pandemic. But if it is a lot higher, maybe conditions aren't as tight as we think they are right now. I mean, that's essentially what's playing out the markets, but that's what we're focusing on as we see how high they'll ultimately go and how long they'll hold at that peak rate.
Well, Cameron, if 5% terminal rate seems quaint, so too does the fact that, just a few weeks ago, we had the markets pricing in that we were going to get, half a percentage point of rate cuts in the back half of 2023. And actually, Bloomberg News spoke to Russ Serto earlier today. He is a managing director of rates over at Breen Capital. He wrote that today's data only underscores how far Powell has to go, saying, quote, these data underscore the stickiness of inflation, that the Fed's job is not finished, and that rate cuts in 2023 are very unlikely. Cameron, what are you thinking about potential loosening? Are rate cuts something that we should be talking about in 2023 still?
No, we don't think so. When we thought that the bond market was getting way ahead of itself in pricing in those 50 basis points of cuts into this year, simply because none of the data would have been bad enough on the growth side or low enough on the inflation side to support an easing of policy. And so we still have about 15 basis points of cuts that are baked in if we look at that warp pricing for 2023. But then there's a lot of cuts priced into 2024 still. And even Fed members in the dot plot have a really wide spread about where they expect 2024 rates to end. And there's about a 300 basis point spread between the high end, which is above 5%, and the low end. So when we go into that March meeting, we'll be watching that 2024 dot plot to see how much of those low end dots pricing in those cuts actually start to move higher in that higher for longer kind of message.
And guys, we're looking at a 10-year Treasury yield of about 3.97%, just knocking on the door of 4%. And if we think about the sell-off that we've seen in the bond market over the past few weeks, that rise in yields, Collin, it strikes me that a lot of that is coming from break-evens when you break down nominal yields. And if we look specifically at 2-year break-evens, they are now above 3% at the highest level since about August 2022. We know this Fed cares very deeply about inflation expectations. How worried do you think they are about this rise that we've seen in break-evens?
I think they are worried because now we're not just seeing it in inflation expectations, but we're seeing those numbers tick up again. And it's not just the 2-year. If you look across the TIPS break-even curve, they're not where they were, say, a year ago, but they've been trending higher, whether it's the 5-year or the 10-year. And we're also seeing it in the survey-based inflation expectations that we got today with the University of Michigan numbers. 5 to 10-year expectations of 2.9% when the Fed's target or goal is 2%. We think that that's way too high. So when we add all this together and figure out what our outlook is and what the Fed's outlook is, it just means that they need to continue to hike, and they're likely to hold for a while. I'll follow up on Cameron's points about the expectations for a potential cut. We see that very unlikely. We thought it was unlikely even before this morning's number, because even if disinflation continues, but if you have a strong labor market, there's really no reason for them to cut rates, since that'd be a form of stimulus, which could just result in inflation ticking higher down the road. So we're not expecting rate cuts this year, and early to mid-2024 is probably the base case right now.
And Cameron, what do you think that means for the bond market in terms of investor appetite? Again, 10-year Treasury yields at almost 4%. When do maybe we start to see some dip buying there?
Yeah, well, we saw dip buying to start the year, and we saw that big rally in bonds, and now it's been completely unwound in just the past couple of weeks. It's been interesting to hear a lot of people think that the 10-year can't break above that 4% level because we'll have what's called real money buying at that level, meaning pension plans, insurers will start to step in and really buy that 10-year in earnest to lock in what is a yield that we haven't seen for quite some time in the past cycle. It'll be interesting to watch, though, because if we do continue to get strong growth data, strong inflation data, that'll push up those inflation expectations as well as the term premia, which could put upward pressure on yields. So I think it's a big push-pull right now to see if we can break above that 4%, probably in the face of increased demand.
And really quickly, before we move on to our next block, Cameron, I want to talk to you a little bit about the yields curve, because I'm looking at the 2s10s yield curve right now. It looks at it's about negative 86 basis points. Do you think that we'll get to triple digits?
I think it's very possible. It all depends on the short end of the curve, though. And it's one of the reasons why we don't think actually that the yield curve is telling us that we are falling into an imminent recession, which just means that really until we see the 2-year start to move significantly lower, meaning pricing in those rate cuts into the 2-year, we don't think that the bond market is actually pricing in that kind of imminent sharp recession that's going to come very quickly. And so we do think that further inversion of the curve is very possible, and that we look to the re-steepening of the curve as the true sign that we're about to enter a recession.
Guys, great conversation so far. Collin Martin and Cameron Dawson both sticking with us. And up next, it's the auction block, a rush of offerings as companies look to get ahead of higher rates. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the auction block, where there were a rush of sales ahead of PCE. We had names like Eli Lilly, UPS, and Kellogg raising nearly $14 billion yesterday. Volume for the whole week comes in around $22 billion, short of dealer estimates. Over in Europe, a rare debt deal from AstraZeneca, which was the sole bond to price today. It's the first deal for the company in 2 years. And a possible sign of the higher rate effect on credit, American Car Center had to pull a sale backed by subprime auto leases. Meanwhile, bonds down, stocks down. We spoke to Gershon Ditzenfield of Alliance Bernstein about that equity bond correlation breakdown.
High yield, is a risk asset and is going to perform in line with equities. The correlation between high yield and equities actually has been pretty stable. But there's no question we're in this good news is bad news type of an environment, and bad news is good news. And for that, we're going to keep on seeing a positive correlation between rates and stocks, which we usually don't see. I think it's really, really important that we pay attention when that changes, because that is a signal that actually things are returning back to normal.
Fran Rodilosso of VanEck joins us now alongside Collin Martin and Cameron Dawson. And Fran, let's start with you. And to Gershon's point, I mean, we can definitely say that equities have been on the back foot over the past few weeks. You're seeing that in the junk bond market as well. Is that the dynamic going forward, both asset classes with more pain to come?
Yeah, I mean, with increased rate volatility, that's certainly a possibility. That, what was happening during the last several Fed hikes before these recent economic stats were that financial conditions weren't really loosening, right? Equity markets were rising, interest rates were falling, credit spreads were tightening. But, I think that was all factoring in an awful lot of good news. Rather than a recession, it felt more like a Goldilocks pricing. So a correction is certainly necessary. We think, pricing some risk back into the market, both credit and equities, in terms of the potential for, earnings declines at some point, entering at least a mild recession. In a way, investors should rather see some of that risk priced into assets.
And Cameron, to that point that, perhaps we're starting to see something of a correction. You look at what spreads are doing. We have seen some backup, but not much. You have IG spreads at about 120 basis points right now, high yield spreads at 420 basis points. Where's fair value?
Yeah. Well, it depends on if we're going into a recession or not, because if we are going into recession, in prior recessions, we saw high yield spreads go well above 700 basis points into the 900 territory and even higher during COVID. It, of course, depends on the deepness of the recession. But it's been interesting just how tight these spreads have gotten through the first part of this year, just because financial conditions have eased. We've seen high grade issuance up 20% year to date. The deals are more oversubscribed than they usually are, and at less of a spread than they have been on the long run average. And this is just a function of the reach for yield. This is investors saying, I'd rather just lock in a high yield, maybe hold it to maturity, even if it does have a period where we see spreads widen and I have losses. As long as I'm holding it to maturity, I can lock that in. But I think it then raises the question, if we see more of a risk off tone, if data does start to weaken.
Well, Collin, that tightness in spreads, particularly in the junk bond market, does that reflect the actual fundamentals of that market?
I don't think it does. We've been kind of confused over the past few months as to why we saw spreads so low when, the concern almost everywhere was slower growth and a potential recession, especially when you see things like the inverted yield curve. We've seen spreads rise a little bit over the past few weeks, which I think is good. I think it's healthy. I think it's good to get more of a yield or risk premium to assume those risks of lending and to high yield companies. But we do think there's room to move a little bit higher. It all does depend on that soft landing or hard landing outlook. But if we look at the aggressive pace of Fed tightening and the impact that has on lower rated issuers, we think that's a big negative, whether it's the loan market specifically, where if you're a standard bank loan issuer, you've likely seen your annual interest expense more than double over the past 12 months. And that's in an environment where you're seeing rising labor costs and you're likely seeing slower growth. So we think that's a big risk. For high yield, you don't see that uptick in borrowing costs in real time. But it does happen more faster than, say, the investment grade market, who has more diversified funding opportunities out there. So we do see risks. We think we'd rather consider investment grade right now just because of those yields offered. Cameron made this point where we do like 5.5%. If you look at the average yield of the IG index, there is risk if the economic outlook deteriorates, but we think that risk is significantly less than what we'd see in high yield, where we'd expect pretty sharp price declines if we do get to a recession.
Well, Fran, what do you like when you look across really the universe of fixed income, not just, high yield or junk, but treasuries as well? Where do you think the most opportunity is at this moment?
Yeah, I think, you have to split the difference a little bit. So going up quality within high yield, double Bs versus triple Bs look relatively attractive from an historic perspective. Recently, that spread had widened out. So, if you're in the risky credit market in levered loans, that's where you're farther down the credit spectrum. That's, a lot of single Bs, a lot of triple Cs and below. The broad high yield market is about 50% double B rated, but you could move into even safer parts, an all double B strategy, a fallen angel strategy. It's difficult to ignore, even in high yield, the absolute yield level of around 8.5%. And I think that's keeping investors in the market to a degree. Of course, we've seen some outflows recently, but there's a lot of carry there to absorb spread widening. And of course, rates would probably come down pretty precipitously if we had a major spread widening. Mm-hmm. So you could see, spreads blow out to 700 basis points or higher. Rates would almost certainly be coming in that scenario, and high yield would do, maybe down 4, 5, 6% in that range. So, you're more protected, you're more sheltered right now. But so, investors have not had this opportunity to take advantage of yield. The front end of the curve, I know there's reinvestment risk when your bills mature or floating rate instruments start resetting lower. But there is, something to be said for taking the carry at the front end of the curve, and investment grade floating rate notes, for instance.
Well, that's exactly what I want to talk about, because I've been specifically looking at the Treasury bill market. And if you look at 6-month Treasury bill yields right now, they're about 5.10%. And then you look at, for example, just the average yield on U.S. investment grade. I think it clocks in around 5.4%. So you look at that. I mean, what is the reason to even venture out the curve? Why not just stay in the short end there? I know investment risk, Fran, is a real thing, reinvestment risk. But what's the case for not just sitting in cash?
Investors are hoping, I would assume, at some point that various fixed income asset classes will play their more traditional roles in portfolios. And you'd expect when your equities or risky credit are declining in value, traditionally that duration would be a good place to be. So aside from the fact that if rates start coming down, if the economy turns, if you are out, 7, 10 years on the curve or farther, you could actually have a little bit of a return buffer against declines in equities and the riskier parts of the credit market. So that's, I think, one reason. Right. I mean, that is what we are hoping for with interest rate normalization. But the process does not seem to be complete. Obviously, the Fed has not succeeded to the degree they wanted to in making conditions tight. And correlations have remained higher than one might have expected when you got 10-year yields back near 10%.
Collin Martin, Cameron Dawson, and Fran Rodilosso, everyone is sticking with us. And still ahead, the final spread. The week ahead, another week packed with data and Fed speak. That's next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the final spread. The week ahead, coming up, Fed speak continues with President Jefferson on Monday, Goolsbee on Tuesday. Then ISM manufacturing in the U.S. and PMI out of China, Europe, and the UK, all on deck on Wednesday. Plus, we'll hear from BOE Governor Bailey. Then we get Europe's CPI and another round of jobless claims in the U.S. And finally, Fed Presidents Logan, Bostic, Bowman all speaking on Friday. Still with us, we have Collin Martin, Cameron Dawson, and Fran Rodilosso. And it's time now for the rapid fire round. 3 questions, 3 quick answers. Collin, I want to start with you. Does the terminal rate get to 6%?
No.
Cameron?
No.
Fran?
No.
Collin, 10-year Treasury yields peaked at 4.3% in October. Do we test that level again this cycle?
No.
Fran?
Yes.
Cameron?
Yes.
All right, guys, we got to leave it there. Collin Martin, Cameron Dawson, and Fran Rodilosso, thank you all so much. And from New York, that does it for us. This was Bloomberg Real Yield, and this is Bloomberg.